Richard Wyckoff discovered the market's most devastating truth through complete financial annihilation, learning that popular trading wisdom operates not as education, but as systematic wealth extraction, designed to transfer capital from the uninformed masses to institutional players. His early losses stemmed from the same deceptive foundation that destroys retail accounts today: the fundamental misconception that markets respond predictably to technical indicators, momentum signals, and news events. These conventional approaches create the illusion of analytical edge, while systematically funneling retail money into professional hands through carefully orchestrated campaigns. The composite man, Wyckoff's personification of smart money, deliberately cultivates these popular beliefs because they serve institutional objectives with mathematical precision. When retail traders chase breakouts above resistance, institutions distribute into that manufactured demand. When panic selling occurs below support, institutions accumulate from that artificial supply. The very indicators taught in trading courses and promoted by financial media create predictable behavior patterns that smart money exploits like clockwork. Wyckoff replaced this deceptive framework with structural reading, recognizing that markets are authored rather than random. He learned to interpret price and volume through effort and result, understanding that wide spreads with heavy volume but no progress indicate absorption, while narrow spreads with light volume yet significant movement reveal ease of direction. The breakthrough came through abandoning prediction entirely, treating risk as operational expense rather than moral confession, and acting only when volume signatures aligned with logical context. This transformation from victim to victor required complete philosophical reversal, seeing apparent strength as potential distribution, recognizing obvious weakness as possible accumulation, and understanding that news arrives like a brass band at the end of the parade, while the tape quietly contradicts headlines. Mastery begins where popular wisdom ends, with disciplined submission to structure over story, patience over excitement, and the calm recognition that markets reward those who read institutional intent rather than chase retail illusions. Wyckoff's transformation from victim to victor crystallized around his discovery of the law of cause and effect, a principle that demolished the illusion of market randomness and revealed instead a universe of authored price movement governed by measurable relationships. He recognized that ranges are not periods of indecision but workshops where the composite man systematically builds causes through time and volume, creating stored energy that will inevitably express itself through proportional effects in the form of trending movement. The law operates with mathematical precision. Larger causes developed through extended horizontal price action produce correspondingly larger vertical effects, while insufficient cause development limits potential movement, regardless of external catalysts. Wyckoff observed that these lateral phases represent deliberate institutional campaigns, where smart money methodically accumulates or distributes positions, using volume signatures to mask their true intent from retail participants. The composite man manufactures conditions opposite to reality, creating artificial scarcity during distribution phases while cultivating false abundance during accumulation periods. This systematic deception explains why obvious fundamental developments often contradict actual price behavior, as institutional objectives require retail cooperation at precisely the wrong moments. Volume becomes the composite man's signature throughout these campaigns, with effort versus result analysis providing continuous verification of intent, wide spreads accompanied by heavy volume yet minimal price. Progress indicate absorption, as institutions quietly gather inventory from impatient sellers. Conversely, narrow spreads with light volume, producing significant price advancement, reveal ease of movement, confirming that supply has been exhausted and demand now controls direction. Wyckoff's fire insurance analogy anchors the practical application. Protection must be purchased before the emergency, emphasizing that position preparation occurs during quiet cause building rather than obvious breakout moments. This understanding transforms targets from wishful thinking into arithmetic, making risk a calculated operational expense rather than emotional drama. Accumulation unfolds as deliberate conflict beneath deceptively quiet surfaces, where the composite man transforms panic into inventory through methodical campaigns that convert time into stored energy. Wyckoff mapped this institutional warfare through distinct phases, beginning with stopping action as preliminary support absorbs initial liquidation waves, followed by the selling climax that exhausts bearish pressure and triggers an automatic rally defining the range's upper boundary. This violence marks the composite man's first intervention, halting decline while beginning systematic inventory gathering. The workshop of cause develops through apparent weakness, as volatility contracts and secondary tests probe previous lows on diminishing volume, creating the illusion of continued bearish sentiment, while smart money methodically accumulates additional positions. The composite man deliberately maintains this lateral grinding to maximize accumulation time, using effort versus result analysis as continuous verification. Declining volume on weakness confirms absorption, while expanding volume on strength reveals emerging control. The spring delivers final deception, a false breakdown below established support, designed to trigger stop losses and harvest liquidity from those anchored to obvious levels. This manipulation provides optimal accumulation opportunities, while creating psychological conditions necessary for subsequent markup campaigns. The key lies not in the drama of the spring, but in the sobriety of the test that follows, as professional buying quietly reclaims broken support on reduced volume and narrower spreads. The danger point emerges when the first sign of strength appears, often following successful spring tests or breakouts above previous resistance within the range. This moment concentrates maximum edge with minimum risk, like entering through a doorway rather than wandering in hallways, where stops belong just beyond structural invalidation rather than emotional hope. Risk becomes calculated operational expense, while reward potential extends to targets measured by horizontal cause development, transforming position sizing from guesswork into structural arithmetic, based on the composite man's demonstrated commitment through patient, methodical preparation. Distribution unfolds as accumulation's precise inversion, where the composite man transforms retail optimism into systematic liquidation through campaigns that convert time into methodical inventory transfer. The process begins with preliminary supply absorbing initial buying waves, culminating in a buying climax where aggressive volume meets widening spreads, yet fails to sustain meaningful progress. This theatrical high marks smart money's first major distribution phase, using retail enthusiasm as liquidity, while the tape whispers exhaustion beneath surface excitement. The workshop of liquidation operates through manufactured strength, as the composite man cultivates false bullish sentiment during lateral development. Secondary rallies test previous highs on expanding volume, yet produce narrower price progress, revealing the critical effort versus result divergence that exposes institutional intent. Heavy volume accompanying modest upward movement indicates supply overwhelming demand as smart money methodically offloads positions into retail buying pressure, while swift declines on lighter volumes suggest weakening support below. The upthrust delivers decisive deception, a false breakout above established resistance designed to trigger momentum entries and harvest liquidity for completing institutional selling campaigns. This manipulation mirrors the spring's function but inverted, creating optimal distribution opportunities while establishing psychological conditions necessary for subsequent markdown phases. The meaning lies not in the breakout's drama, but in the failure that follows, as professional selling quietly overwhelms retail buying when price slips back into the range on increasing activity. The last point of supply emerges as the distribution's danger point, offering optimal short positioning following confirmed upthrust failures or rallies that reveal their poverty through disproportionate effort. Risk becomes structural calculation with stops placed above the upthrust high, transforming position management from emotional drama into precise operational expense. Volume signatures confirm the composite man's liquidation intent, while measured cause across the distribution range provides logical targets for ensuing markdown campaigns, ensuring reward aligns with demonstrated institutional commitment to drive prices systematically lower. Institutions wage psychological warfare with surgical precision, extracting what Wyckoff termed the human tax through hope at distribution tops, fear at accumulation bottoms, and ego throughout every phase between. His personal devastation revealed that markets punish entitlement while rewarding submission to structural law over emotional preference, as the composite man deliberately cultivates false optimism during upthrust campaigns and manufactured despair during spring manipulations. This emotional orchestration operates with mathematical reliability because human nature remains constant, while institutional objectives cycle through predictable accumulation and distribution phases. Hope emerges as the most destructive force, anchoring retail traders to deteriorating positions as last points of supply develop and volume signatures reveal institutional selling. The hopeful holder refuses stops during obvious distribution, averaging into professional liquidation while rationalizing weakness through fundamental narratives that arrive precisely when smart money requires retail cooperation. Fear operates as hope's systematic inverse, causing traders to abandon confirmed danger points when springs complete, and signs of strength emerge, scalping modest profits, while missing substantial markup campaigns that reward patient structural reading. Ego compounds these traps by overlaying opinions onto clear tape testimony, manifesting through position sizing based on confidence rather than measured cause, moving stops to avoid operational expenses, and arguing with effort versus result analysis when personal predictions conflict with institutional intent. The composite man coordinates news flow and social sentiment to amplify these responses exactly when psychological compliance serves professional objectives, celebrating strength into upthrusts while lamenting weakness into springs. Wyckoff discovered that mastery requires treating markets like instrument flying through fog, trusting structural readings over intuitive sensations, while maintaining discipline through systematic protocols established before emotional pressure arrives. Pre-commitment replaces improvisation, as traders write in validation levels and define risk parameters independent of mood, transforming trading from emotional drama into operational craft, where patience becomes active. Positioning and small, frequent, rule-congruent decisions compound edge over time. Wyckoff's complete transformation from financial devastation to methodical mastery crystallized around 10 immutable propermist market truths that compress chaos into operational clarity, forming a compact doctrine where chaos becomes craft through disciplined submission to structural law. His synthesis recognizes the composite man as institutional reality rather than theoretical construct, the silent author of every significant price movement, who orchestrates systematic campaigns through measurable cause and effect, relationships that govern all market behavior with mathematical precision. The foundation rests upon supply and demand operating as living forces revealed through the tape, where effort versus result analysis serves as the crucial Rosetta Stone for deciphering institutional intent beneath manufactured surface conditions. This principle exposes when heavy volume produces minimal price progress, indicating absorption during accumulation phases, or when modest volume generates significant movement, revealing ease of direction. As supply becomes exhausted, markets cease being random fluctuations and transform into authored narratives where every substantial trend represents the measurable effect of preceding causes, built methodically within horizontal ranges. Accumulation and distribution ranges function as workshops where smart money converts time into stored energy through patient horizontal development, with springs and upthrusts serving as deliberate invitations rather than accidents. These manipulations concentrate maximum edge at precisely defined danger points, where risk becomes minimal operational expense rather than emotional confession, while the path of least resistance guides position direction as institutions systematically remove obstacles through methodical absorption or liquidation campaigns. The transformation from intellectual understanding to consistent profitability requires complete philosophical reversal. Structural reading replaces prediction, cause measurement determines position sizing, and patience emerges as active strategic positioning rather than passive waiting. Daily practice becomes monastic in its regularity, where ranges are scanned for institutional sponsorship. Horizontal cause is measured to propose reasonable objectives. Entries are timed at danger points, where volume signatures confirm character, and positions are funded with predefined risk that remains small, boring, and survivable. Mastery flows not from complex indicators or insider information, but through quiet, repetitive craft, where discipline replaces hope, logic supplants narrative, and consistency transcends excitement. True professionals develop selectivity as their primary weapon against institutional manipulation, recognizing that most apparent opportunities represent carefully constructed traps designed to exploit retail impatience and greed, while success rewards those who read institutional intent through systematic protocols established before emotional pressure arrives.